Well, hello and welcome back to Principles of Macroeconomics. I am still your host, Dr. B. Happy to have all you with us today as we talk about finance. Now, you might be asking, hey, Dr. B, this is an economics course. Why are we talking about finance? How is it related? I don't understand why we talk about finance in an economics course. I think that the reason why it's important that we explore finance in an economics course is because of the way economics works. When we talk about the greater economy, we're talking about the exchange of goods and services, and it's usually there's a monetary involvement here with cash, right? So why not talk about finance? Cash and finance go hand in hand, right? So that's why it's important for you to understand some basic fundamentals of finance. For those of you who have had accounting with me, the things that you'll learn from finance are very much related to accounting to some degree. When we talk about things like the time value of money. The reason why we talk about finance is because we talk about money in economics. So that's why it's important that you understand a couple basic tools to utilize as we explore economics. So I'll briefly talk to you about a couple of very important finance tools that you should know in order to help you when it comes to economics, like investing in stocks and bonds and your retirement plans and your savings, those types of things that you would normally do. It's important to understand how things work behind it, right? And so that's why I think today's lesson on finance is going to be very important. So, first, we define finance as being the study of how people make decisions when it comes to allocating resources over time. For example, how individuals save, how individuals invest, how individuals spend their cash, their money, their earnings. Yep. So, finance is the study of those things. And it's also the study of how we handle risk. As we talked about last week, risk is involved in a lot of different things when it comes to decision making. We look at risk from the perspective of investing, we look at the risk of different markets and the way that they change, external, internal factors, those kinds of things. So, finance is looking at how we handle things like savings, spending, investing, and also how we deal with risk. One of the primary things that you should understand is how much money is valued. The value of money. Value of money is looked at in a couple of different ways. First, we look at the value of money in what we call the present value. This is the amount of money that today that you would need in the future. Okay, time, it's called the present value. With respect to present value, we look at the amount of money that you would invest today based off of the amount of money you would need in the future. So, for example, let's say you want $100,000 in your savings account in 10 years from now. Well, how would you figure that out? How much would you need to invest today in order to generate $100,000 in 10 years from now? Call that the present value of money. It tells us the amount you need presently, today, in order to generate a certain amount of money in the future. That is the present value of money. So, example is, you want to generate $100,000 in 10 years from today. How much do I need to invest today in order to generate that kind of money? Well, we calculate what's called the time value of money formula for present value. We'll talk a little bit about that shortly. It takes into consideration the interest rates, and also the time, right? That's why we call it time value of money. So that's present value. The other side of that coin is called future value. Future value tells us, based off of the amount of money we want to generate in the future, what would the amount yield today? Okay, what would the amount yield today? So in other words, in today's dollars, if I wanted to generate $100,000 in 10 years from now, what would that $100,000 look like today? What would be its value today? That's the future value of money. Of course, we use interest rates to calculate these things. The third component you need to understand about finance is called compounding interest. Interest compounds over time. It accumulates over time. Example, if I put $1 in my savings account today, it yields a 12% interest per year, and it's compounded annually. At the end of the year, I would have $1.12 in my bank account. Okay? Because the interest rate. Now, for that next year, instead of earning again on that same dollar, now I have $1.12 in my bank account. I leave that $1.12 in the account. Another year passes. Now I have $1.36 in the account. That's because I've earned interest on top of the interest already earned in the account. We call it compounding. You're adding interest on top of the interest you've already earned. You see, that's why we call it compounding interest. And we'll talk more about this as well. So let's take a look at the present value of money. Here we have an example. We have here, I don't have my financial calculator with me, but we have here example of $100 in the bank account today. How much will it be in a certain number of years from now? Well, the way we do that is we would use a financial calculator. The great news is the internet has time value of money calculators available. So you can just simply search for time value of money calculator in your browser. And you will find a couple of options for different calculators out there. All you need to do is plug in the values in order to solve for the present value of money. So what you need is the present value, in this case $100, the interest rate, we'll say 8%, and the time, or number of years. We could say 10 years. And so you plug that information into the time value of money calculator, and you'll get your answer, which tells us what the value of $100 today would be in whatever number of years. Very, very helpful calculation. The best application for this type of calculation would be for your retirement fund. Let's say that you want a $500,000 in your retirement account by the time you're ready to retire. Yeah. So how do you figure that out? How much would you need to have in there today in order to reach that $500,000? So you punch in, and we can look at the future value for that. So there's a lot of great ways to use time value money calculations, but the biggest application would be for figuring out how much you would need in retirement. Another way of doing this is, let's say you're saving up for a down payment on a house. You could use this type of calculation as well. So let's look at it in terms of future value. So let's say you want to generate $200. Let's say you want $200 in the future, and we'll say 2 years. How much would you need to put into your bank account today in order to get that $200 in 2 years? We call that the future value of money. And so future value would be $200 in 2 years. The interest rate, whatever the interest rate is, you plug that in. And the present value calculation would be 200 divided by 1 plus the interest rate to the power of the number of years. So you can use your calculator to do this, or you can use the time value of money calculators available on the internet to solve these types of problems. When it comes to future value, we use what's called the discounting rate, which is substituted for the interest rate. So the general formula for discounting is we take the value to be received in the future, divide it by 1 plus the interest rate to the power of the number of years it would take. Again, when it comes to time value of money, my recommendation is to use a time value of money calculator found on the internet, just by simply searching your web browser for time value of money calculator. Yeah. Or of course you can use a financial calculator, or you can use a simple mathematical calculator, but we want to make sure that it has the ability to do power. Yeah. That's time value of money. Again, very useful concepts to understand. When it comes to finance, it's important to understand your risk. Personally, I try to avoid risk. I don't like putting my money at risk because I don't want to run the risk of losing it. I'm what you would call risk avoidance. Yeah. We all have our own tolerance for risk. The older that we get, the less risky our investments should be. I don't like to play the stock market game in my older age. If I were a younger person, I might be more willing to take on more risk by purchasing certain stocks, right, that are a little bit higher risk. Remember, with higher risk, often comes higher returns. If I purchase a share of Apple stock today, I would consider that to be a risky investment. Why? Because Apple stock can sometimes be very volatile. It goes up, it goes down. If I purchase a share of stock today, what if the stock market goes down tomorrow? It's the risk. That's the risk you run. Yeah. So you have to understand what your risk tolerance is. You're purchasing stocks. Okay. So it's almost impossible to avoid risk. We know that. It's almost impossible to avoid risk. There's always going to be some inherent risk involved. It's just a matter of understanding the risk and your risk tolerance. Okay. When it comes to investing, we use what's called a utility function to understand risk and to understand how the investment works from a utility perspective. Utility function shows us the measure of satisfaction. It shows us the usefulness of the investment, utility. Every level of wealth provides a certain amount of utility. Okay. Wealth is generated from making wise investments. Your wise investments help to generate income, helps to generate wealth. Based off of your wise investments, you can generate utility. It's also important to understand that based off of your investments, the law of diminishing return applies. Diminishing return is kind of like the bell curve, yeah? You can keep investing, eventually come to a plateau, and then eventually it'll start to drop off. Bell curve, if you will. The law of diminishing return applies to investing. The more wealth a person has, the less utility they will receive from each additional dollar of investment. Okay? That's why you see wealthier people don't earn as much after they've already established a lot of wealth. The reason for that is because there comes a point where the more that they invest, the yield of return just is not as high. And the best way to describe that is through this graph. This is the law of diminishing return, also known as the utility function. You can see that as time goes on and as wealth increases, the utility is less useful because of the law of diminishing returns. So we've talked about time value of money, we've talked about utility. Now, of course, I want to talk to you about insurance. We all have insurance for things. We have personal property insurance, we have vehicle or automobile insurance, we have renters insurance, we have homeowners insurance, we have pet insurance, right? There's so many different insurances out there. There's an insurance for almost everything, most things. Okay. The only thing that's not covered is what we call act of God. Act of God. An act of God is when a meteor falls from the sky. Not covered. Okay. Or other things like volcanic eruption. We call it act of God. Act of God things are not covered by most insurance policies. Okay. Insurance helps us to mitigate risk. That's why we have insurance. Okay. You have automobile insurance in the event that someone else hits your car. Something happens to your car. Your car gets stolen, your car gets blown up, a tree falls on your car, these things happen, right? Insurance covers most things, okay? When it comes to your car. Your car is an asset. It's a personal asset. Insurance helps to mitigate the risk. It covers things in the event of damage or loss in most cases. Insurance also helps other areas of risk. Okay? It protects you in the event of risk. That's why we have insurance. The insurance contract tells you exactly what the insurance company will cover in the event of risk. The insurance, you pay a premium for the insurance. You pay insurance every month or every year for your assets, your house, the rent, your vehicle, your pet, your whatever else you have insurance for, your life insurance. We pay insurance premiums. It's the fee, it's the cost of the insurance that you pay every year. Okay? We call that insurance premium. What do you receive in exchange for that premium? Hopefully, you're not claiming on your insurance every year. If you are, there's a good chance your insurance company will drop you. Insurance, the idea behind it is it provides you with peace of mind. We pay insurance because we're mitigating the risk of something happening to us in the future. When something happens to you in the future, if you're insured, you have what's called peace of mind. Be taken care of. Okay? It's like, oh, something happened to my car. It's like, yeah, you'll be upset up front. The good news is you're insured. So they'll help to mitigate the risk. So insurance is not going to cover everything. You're still going to have to pay a deductible. You'll still have to pay, some small amount. Right? But insurance is there to help to mitigate the risk. When things happen, that's why insurance is there. That's what it tells us. Insurance companies, the way that they operate is that with the premiums, the higher your premium is reflects the amount of risk that you pose to the insurance company. If you pay a higher premium than other people with similar types of attributes, the insurance company has identified you as being a higher risk client. The higher premiums, the more risky you are to the insurance company. That's why, you'll notice that insurance companies, the longer you stay with them and you don't have any claims, your policy might go down. Your premiums might go down over time. Yeah, that's because you're less risky. The older you get and the less claims you have, your premium will probably go down over time. It's how, again, insurance companies use the premium to determine risk. That's the idea behind it. That's insurance. Let's talk about my favorite thing, stocks. When you invest for retirement or you like to buy stocks, it's important that you diversify your portfolio. Diversification is extremely important when it comes to investing. You want to make sure that you don't place all your eggs in one basket. Here's what I mean. When I buy stocks on the stock exchange through my brokerage account, I don't just buy tech stocks. It's dangerous. Don't just buy one kind of stock. You want to diversify. You buy a little tech stocks, healthcare stocks, um, home product stocks, uh, hard stocks, maybe media stocks. You want to diversify your portfolio. Don't just invest in one single um, area, stock market. Don't just buy tech. You want tech plus everything else. Diversify it. Okay. So it's really important that you diversify your portfolio. One thing that I recommend that you do to help you to diversify your portfolio is to purchase mutual funds. A mutual fund is a bunch of different stocks wrapped up into one product. Yeah, it's called a mutual fund. So that's the kind of investments I like because it helps to diversify your portfolio. It spreads the risk around. Yeah, that's what it means. So the riskiness of your stock portfolio depends on the types of stocks that you have. I would never, ever, ever, ever tell you to buy Bitcoin or any type of cryptocurrency. It is way too risky. It is extremely volatile. It is very, very high risk. It is unregulated. It is not backed by a physical asset. So that's why you'll never hear me say buy cryptocurrency. No, don't do that. It is way too risky. It's something I would never ever do. So I would strongly recommend do not buy cryptocurrency. Stay away from that stuff. Too dangerous, too risky, volatile. It goes up and down it's crazy. Okay? Stay away from that stuff. Stay away from other fad or trendy investments. For example, a bunch of investors got together to try to save AMC theaters and GameStop. It lasted for a little bit and then it kind of fizzled out, right? So stay away from those fad or trendy type things. It doesn't last long. Yeah. So it's important to diversify your portfolio by buying different types of stocks in different sectors and spread it over time. Yeah, it lowers the risk. Here's a nice graphical representation of that type of diversified fund. So you can see with a greater number of stocks in a portfolio and different companies, the wider the spread is, the less riskier the total investments are. That's what this shows us. Again, it goes back to what we call diversification. Diversifying helps to limit the amount of risk. Okay? You always have risk. Risk is inherent. You can't get rid of it. It's impossible. But you can limit it. So that's why it's important to diversify your portfolio. There are really two types of risk. One is called firm-specific risk, and the other is called market risk. Firm-specific risk is risk tied to a specific company. Earlier, I gave the example of Apple. Okay, Apple can be somewhat risky at times because it's a very large tech company, and if they make a wrong move, the stock can plummet. So it's like, oh, Apple decided to switch over to the C charger, the C USB-C. When they made that decision, their stock didn't do well. Okay, because they got rid of the lightning charger, whatever it's called. So yeah, that's what we call firm-specific risk affected that company. The other is called market risk. This affects all companies in the stock market. Market risk is when a war breaks out in Ukraine or in the Middle East. Okay, the market doesn't like war, so it's very volatile times of war. Okay, the market doesn't like uh, when interest rates go up. The whole market is affected when a decision is made by the Federal Reserve to raise interest rates. We call that market risk. When it comes to investing, there's two types of assets that I want to talk to you about. One is called the diversified group, and the other one is called the safe alternative. The diversified group has usually an average of an 8% return, which means for every dollar you invest, 8% of it is in growth. And has a 20% standard deviation. An example of a diversified group is the Standard & Poor's 500, also known as the S&P 500. It is an index of 500 companies, of the largest companies in the United States on the stock exchange. We call that the S&P 500 a diversified group. The other type of asset is called a safe alternative. Safe alternative provides you with a 3% return on average, 3% growth, and a 0% standard deviation. An example of a safe alternative is a bond, government bond. You purchase a government bond, the guaranteed return rate, usually of about 3%, and a 0% standard deviation. A bond is a safe alternative to a stock market investment. That's the best way to think about it. Of course, the trade-off here is that the more risk you take on, the greater your return is. But the opposite is also true. The more risk, the more riskier it is, you might lose more. Something to think about. This is the correlation between the risk return between stocks and bonds. A bond, no stocks. You invest in a bond, 3% return, 0% standard deviation. And then we see stocks, right? 25% stocks, 50, 75, 100. The more stocks you have in your portfolio, the greater the risk is, and the greater the standard deviation. When it comes to investing, it's really important to understand how a company is valued. How do we value a company? How do we say how much a company is worth? That's a hard thing to measure. It's a hard thing to understand. Do what's called a fundamental analysis. And I do this for every investment I ever make. First thing I do is I study the income statement, the balance sheet, statement of cash flows, and statement of retained earnings for every company I decide to invest in. Those of you who know, you've taken an accounting class with me before, you know that those are the four primary financial statements in accounting. And by analyzing those four statements using ratio analysis, horizontal and vertical analysis, by analyzing those four financial statements, you can make an investment decision. And you can understand the value of the company. When it comes to the stock price is undervalued if the stock price is less than its value. It's overvalued if the stock price is greater than its value. And it's fairly valued if it's equal to its value. So, what are the fundamental when it comes to picking stocks? Do your own research. Don't rely on market analysts. Okay, do your own research. You want to invest in a particular company? Great. Go to that company's website, find their SEC filings, read through their financial statements, the 10K report, do your own calculations to determine if that's the right company for you to invest in. Check out what Wall Street's saying about the company, understand what analysts are saying about the company before you make an investment decision. I strongly encourage you, when you do make investment decisions, to look at mutual funds. As I mentioned earlier, a mutual fund contains a lot of different stocks in the portfolio, and it's diversified risk. Think about the market when you're making these investment decisions and what may or may not happen. We look at things like the asset prices based off of all public information available about that company. When news comes out about a company, it affects their stock price. Example, a few days ago, United Airlines announced a change in the way that they board their flights. Customers will now board starting with the window seat first, and then the middle seat, and then the aisle seat. The reason why this change has been made is because the airline determined that they can save a whole 2 minutes in the boarding process. Now you're thinking to yourself, oh, 2 minutes, it's not really that big of a difference. When you have 15,000 flights a day, 2 minutes per flight, adds up to millions of dollars in savings for the airline. When that news broke, the stock price for United Airlines increased by about 15%. So all public information available has major implications for the value of the stock. Okay. Follow the markets closely to understand what the equilibriums are for the market price. Stock markets are based off of information, so follow the information as best you can. You'll never have the full picture. You want to have as much information as possible at your disposal before you make an investment decision. The stock market is relatively rational, but it can react irrationally on occasion depending on the news. What can I tell you? Having the most information available is so important. I mentioned that sometimes the stock market can react irrationally. Sometimes people make guesses about whether people will buy or sell based off of the underlying value. We call it speculation. Never invest based off of speculation. That's too risky. The fluctuations in the stock prices are partly psychological. The reason why stock prices fluctuate is because of the changes in value. The buying and selling of stock at certain volumes will impact the stock price. Some people think it's because of changes in behavior. To some degree it is. But it causes the market to behave irrationally. The prices of a share of stock change. Sometimes it's because of speculation. Also, sometimes it's because the stock price is above its fair value. It's important that as a stockholder, look at things like possibility of future dividend payments and its final sale price before you make an investment decision. The last thing about market irrational, of course, about things like the news cycle. News cycles have impacts on the stock price. If something happens with a certain vice president or CEO, it's not good, it makes its way into the news, the stock price is probably going to go down. And of course, it's almost impossible to time or guess what will happen in the future. So, with that, make your best decisions possible in the stock market. Hey, that is the end of our discussion in terms of finance. Any questions on finance or stocks? Any questions at all about finance or stocks? Hopefully you learned something from that, especially when it comes to investing. Okay, before we jump on our discussion on unemployment, I just want to quickly show you where we are in the classroom. Week 10. So here we are. We just got done with finance. We're going to talk about unemployment next. The one that's related to what we just talked about, or what we will talk about, is going to be in the next chapter. We have a hypothesis on unemployment, which is the next chapter. We'll talk about that here shortly. And of course, you have a chapter 14 and 15 quiz. And so let's jump into our discussion on unemployment. So let's just quickly shift gears on that topic. So please stand by.